Hey everyone, it's Robert here. So today we're going to be talking about interest rates. Why isn't my interest rate what I see out on the market? Isn't my credit score the only thing that really matters? Well, there's a lot of questions when it goes into interest rates, and the answer is no. Credit score is a big factor in determining your interest rate, but it's not the only factor. In addition to the market moving up or down, lenders use something called risk-based pricing. That essentially means the more risk there is on your loan, the more the lender needs to offset and mitigate that risk, and they do that through increasing prices on you. Your interest rate goes up so that they can collect more money from you. Let's take a peek at what the lenders look at in determining the risk level. Starting with the already mentioned credit score. This one is big. It lets the lender know your willingness to repay a loan. If you don't pay your other bills on time, that's a higher risk to the lender that you may not repay them. The other big one is down payment. The more you put down, the less risky it is to the lender in case you default and they get your home as collateral. In case that happens, they prefer to have some equity to work with to sell it in order to try to break even or make a small profit if possible. We can actually see these risks and how they affect us in the Fannie Mae loan level pricing adjustments, and they are available to be seen by us, the public. I'll leave a link in the description, but you can also Google Fannie and Freddie's adjustments. This can give you an idea of how much your rate will improve if you can improve your risk factors. Let's look at the matrix. Credit scores are at the left, with LTV or loan to value at the top. Loan to value is the inverse of down payment. For example, 20% down is 80% loan to value. But what is all this in the middle? Those aren't interest rates. Those are loan level pricing adjustments. The lender aims to make a certain profit margin on each loan. So, based on the risk of the loan, they will pass the adjustments back to you in the form of points. In this screen, you can see that if you have a 720 to 739 credit score and put 20% down, the lender will make you pay 0.75 points. If you have a 740 plus credit score, you will only pay 0.5 points. I want to go a little deeper, but I need you to keep this in mind. The way lenders think, positive points are charged to you and negative points are a credit to you. So the lender is able to offer you the pricing you see on the screen. Since you have a 720 credit score, they tell you your rate is 4.5, but if you got it to 740, it would be 4.375. Why is that? The lender is quoting you the par interest rate, or the rate without any charge or credit to you. This is because your loan level adjustment has a positive 0.75, which is offset by the negative 0.75 credit for the 4.5% interest rate, which creates a net price of 0. With a higher credit score, the loan level adjustment decreases to positive 0.5, which decreases the par rate to 4.375 because it has a negative 0.5 adjustment. Again, this nets to 0. However, you don't have to take the par rate. The lender can offer you a range of rates to select from. You will get a credit or pay points based on the rate you choose. 1 point is equivalent to 1% of your loan amount. So on a $200,000 loan, 1 point is equal to $2,000. You might opt to select a higher interest rate for a cash credit if you think you will soon refinance into a lower interest rate or sell the property. On the other hand, locking in that low interest rate on your forever home if rates are rising and paying the points isn't a bad idea either, as those benefits will show in the long run. Let's talk about some other risk factors. Occupancy type of property, and program features, and even other lenders can all be various types of risk. For example, time has shown a person is more likely to default on an investment than their personal home. Thus, the risk is higher for investments compared to primary residences. Program features are broad and numerous, but many of them are higher risk. An interest-only loan, for example, is much higher risk than one where the lender also collects principal in the payments. Condominiums have risk due to the involvement of associations. Multifamily homes have risk associated with vacancy. Subordinate financing, or a second lender, also bear risk due to having multiple lenders involved for the same collateral. If you have rate questions, I recommend contacting your lender for more information on what their current adjustments are and comparing it with a second lender to make sure you're getting a good deal. But I hope this video was insightful in helping you understand why your interest rate is the way it is. If you can improve upon these factors, your interest rate should surely improve. The only other thing that might be affecting you is something outside of your control, and that's just the general trend of the market. See, mortgage rates tend to follow the 10-year Treasury notes quite closely. When they go up, so do mortgage rates, and when they go down, so do mortgage rates. So keep that in mind when comparing a quote from today from one from a few days or a few weeks ago. This is Robert, signing off.